All right, let's do this thing. This is super exciting. Assumable mortgages. I think it's a really great opportunity right now. Are people familiar at all with them? Heard of it? Like, raise your hand if you've heard of it. So, cool. I'm gonna go pretty in depth on what they are and how it works and how you can find these deals. Who is hoping that interest rates come down? Yeah, well, this is a great way to like reach back in time and grab those low interest rates without having to wait for them to come down. So let's talk about it. Assumable mortgage. So basically what it is a loan that is assumable to the buyer. So you get to take over the loan balance, the terms, how much time is left on it, and the interest rate. And any government-backed loan is assumable. So FHA, VA, or USDA. There's not really any USDA loans in Colorado Springs. It's not rural enough. But there's a ton of VA and a lot of FHA loans in Colorado Springs. The biggest thing to know when thinking about if this will work for you is the equity gap. And we'll get more into that in a minute, but I just want to define the term here. Equity gap is a difference between the value of the home or the listing price or what you're going to offer and the loan balance. So somebody got a loan, the seller got a loan 2-3 years ago at whatever it was. They've paid down that loan a little bit. The home is appreciated in value, and that gap is called the equity gap. So in this example, $525K is the home value. They paid the loan down to $500. The equity gap is $25K. We'll talk about how that can be paid for in a little bit. So here's another illustration on how that works. This is what it's listed for. That's their loan balance. And 100K is what you've got to come with cash. So for the equity gap, you can use cash, you can use a HELOC, you can use a gift, or we work with lenders that will actually do second position loans up to 85% of the value of the home as a second mortgage. So if the equity gap is like 200K and the property is $1 million, you got to bring 150, but they'll finance 50 of it, right? So there's some sweet homes out there with massive equity gaps, and you can get a pretty big loan on them. There's a bunch of misconceptions with assumables. People think they're not possible, or they're terrible, or they're just going to fall through. One misconception is that it takes a long time to close. And I hear this from agents that like tried to do it themselves, and it took 6 to 9 months, and everyone was frustrated, and then some of them just give up. And right, that's a horror story, going through 6 to 9 months to try and get something to close. It doesn't. And then those stories spread, and people have a bad opinion of them. There are several companies that have popped up that their whole business model is being the go-between and being the expert on pushing through assumptions. And so they will work with the buyer, the seller, and the servicer to make sure that happens. These loan servicers that have got 3.25%, 2.75% interest rate loans on their books would love to do everything possible to get them off their books and not have it be assumed and keep it for another 30 years. And so they add as much friction as possible. Garrett's under contract on one. I was under contract on one. They send you a packet, paper packet, that you have to fill out and mail back, right? So just an example of them trying to add as much friction to this process as possible. And so it does take a little longer, and it's a little more work, but you'll see shortly why that's worth it. So anyways, these companies that you can pay to help basically facilitate that process will get it done in about 60 to 90 days. That's what they're averaging. And some servicers these days are getting it done in 30. It depends on who owns that mortgage and is servicing it. So some of them play a lot nicer than others. There's a company right now that does a 45-day guarantee. If they don't close in 45 days, they will pay the seller's mortgage until it closes.
Who are some of the better servicers, Brian?
There's mortgage servicers that are easier to work with.
Yes.
Veterans United is one of the quicker ones. I don't have that list in my head.
I've heard good things about like Penny Mac.
I've heard good things about Penny Mac. Another big misconception is that only veterans can assume loans. So VA loan is a super popular one, Colorado Springs, that can be assumed, but FHA loans, again, can also be assumed by anybody. Also, if a veteran is willing to leave their entitlement with the house, then anyone can assume that loan. And there's a lot of reasons why that might be beneficial for a veteran that needs to move or wants to get out of a house quickly. Maybe they're getting a ton of cash or getting a premium for it, and they can go use a conventional loan or FHA loan and put 3.5%, 5% down on their next property. If they've got some equity, they've probably got the cash to do another type of loan on their next purchase. Have to have a ton of cash to do this. So people think that equity gap is going to be huge. I've got a list that I'll show you at the end here, but there's some where the equity gap is negative, and the seller is going to have to pay for you to assume their loan. There's some where the equity gap is $1,000, $10,000. So you can buy these assumable properties for less than 5% sometimes. So less than you would have to put down on a primary purchase anyways. I will say if you have 50K or access to it, it opens up a ton of doors because there's a lot of homes that are, around that 30 to 50K range for equity gaps. So here's the benefits of assumable mortgages. This one's stark. So if you're assuming a 500K loan at 3.25%, your monthly payment is almost $2,200. If you're buying a home and you get a 500K loan at 6.8%, your payment is almost $3,300. So the difference in monthly payment is $1,100 if you were to buy today versus being able to assume a 3.25% rate. So this is huge for a couple reasons. One, it makes homeownership way more affordable to a lot of folks. And two, if your goal is to scale with house hacking, then you need to be able to cover most of your mortgage with a lease or with rental income, cancel out that debt on your DTI, and be able to qualify for the next one. So if your goal is to scale, then this is also a great way to make that happen. This is the biggest benefit in my mind to assumable loans, and it's pretty shocking. This is the amount of principal you'll pay down in 5 years, the amount of interest you pay in 5 years, and the amount of interest you'll pay over the total life of the loan with different rates. So 500K loan, 3.25%, you'll pay $53,000 in principal in the first 5 years compared to only $30K at a 6.8% interest. So a difference in $23K of the principal you're paying in the first 5 years. As far as interest paid, 77 versus 165. So today's rates versus a 3.25%, $88,000 difference in interest in just the first 5 years. Hopefully rates are going to come down the next 5 years and you can refinance and you're not paying quite that much interest. But this is what's shocking. Over the life of the loan, $390K more in interest. That's a lot of money. Just want to make it really clear that assumable, some people get this confused, is not subject to. Subject to is a gray zone. It requires a ton of cover your ass paperwork and understanding how all that works. And this is not that. The lender is involved the whole time, is involved with the process, completely legal. It's in the loan documents. So really want to be clear on that distinction. Quickly want to go through the process here. Pretty similar to buying another home. Step one, you got to find a home with an assumable loan, so FHA or VA. You got to figure out the loan balance, how much is left. Figure out the equity gap, so the loan balance, or the asking price minus the loan balance, again, is the equity gap. Write an offer with all the correct assumable clauses and deadlines in it. Work with a realtor, mortgage servicer, and assumption company to get to assume the mortgage, and then you close. That process, again, takes a little longer than a traditional close because of all the friction that the loan servicer is adding. Why would a seller, this is a question I get a lot, why would a seller want to let somebody assume their loan? Does anyone have a guess on why a seller, besides what I just showed? Anything else?
Better marketability.
Yeah.
Charge a premium.
Charge a premium? Yeah. I'd pay a premium for a 2.75% rate. I'm going to pay $11K easily in principal off every year. If I'm going to hold that for 30 years, I mean, you saw the interest I'd save over 30 years, right? I'm gonna pay a premium for that. Any other ideas?
They might be upside down on the balance and just need to let the property go at a wash.
Yeah. Yep. So the biggest one I'm finding, or what I'll explain to people, is that marketability piece, right? If your home is trying to stand out against all the other ones on the market for all the potential buyers that are looking at them. And so if there's a home next to you that's the exact same, but no one can assume the mortgage and they got to buy it at 6.8%, it's the same price, which one's going to go under contract quicker? The one with the lower rate. And so this helps sellers get their property under contract a lot quicker and potentially for a premium. So what am I doing to find these deals? I want to share this, and at the end there'll be a QR code. If you want access to this list, you can fill out a form and get access to it. But we are identifying all the properties that are assumable on the market in El Paso County, and we're writing all the important information on there. So we got the interest rate, the asking price, the loan balance, the equity to cover. Will the seller allow somebody without VA entitlement to assume it? And then, what type of loan it is. So is it only VA? Is it a VA that will let someone that's not a veteran assume it? Is it FHA? So there's a couple different ways we're finding those, and we're putting them all in a spreadsheet so that people can see them. And then I've also have a way of creating searches that you can put a bunch of criteria on and get these assumables sent to your email daily. So if your criteria is a certain number of bedrooms, bathrooms, interest rate, you only have $50K that you can put towards an equity gap, so it needs to be lower than that. And it identifies, because it's public record, VA, FHA, what type of loan it is. So any home that comes on the market is then scraped against this, what type of loan it is database, and then we can figure out if that loan, or if that home is assumable, and then all the other details. And so you can set up a search like that and get access to it. And then another thing I'm doing is for investors. So let me back up. In this spreadsheet, when it says non-veteran, basically we've confirmed with the listing agent that the seller is willing to leave their entitlement with the home and allow someone who's not a veteran to assume their loan, which means an investor can buy that. It does not have to be your primary residence, which is not very well known and is a sweet opportunity for folks to be able to buy investment properties for, in this case, right, $95K for 485, so almost 20%, maybe a little more, what you're going to put down on investment property anyways. But there's some investment properties here where the down payment is 5 or 10%, which you cannot get a loan for an investment property today, can you, Jeremy? 5 to 10% down on investment property? And assume a great rate. So it's a pretty awesome opportunity for investors. We're trying to identify those properties.
Hey, Ryan.
Yeah.
If you assume an FHA property, do you have to owner occupy that?
FHA is only owner occupied. Investor can never assume an FHA.
So if you're not VA, or if you're not a veteran, and you don't want to owner occupy, you have to do a VA assumption and they have to give up their entitlement?
Yeah, the only way an investor can assume a mortgage is a VA loan that and a veteran is willing to leave their entitlement in the home. That's the only option for an investor.
So Ryan, so if it's a conventional loan, somebody primary residence conventional loan, is that out there where you could assume?
Conventional or not assumable.
Completely not assumable?
Yeah, conventional is not assumable. So when we identify these properties that are assumable to investors, we're running some rental comps on it, and we're sending out what's the interest rate, what's the equity gap. We're running an IRR calculation on what's the projected annual rate of compounded annual rate of return, right? And then we're running some net worth ROI, and then we put in principal, interest, taxes, insurance, what it could rent for, and so you can see that difference. And then I like to throw in the principal pay down because that that's a lot higher than it is today. And so I think it's important to remember that when you're thinking about the whole picture of investing, right? It's not just the cash flow, it's the appreciation, principal pay down, and the tax benefits that create a really awesome return. So, and we're finding some off-market deals. So I pulled a list of 5,000 properties in El Paso County that are VA or FHA. I've identified the best ones with a good combination of a low equity gap and a good interest rate, and I have sent out mailers to them, and we're starting to drum up some off-market deals that my clients would have access to before they hit the market. And then the big part of what I do is when clients want to make offers on Assumables is calling listing agent, educating them, right? Going through any of those misconceptions that they might have about assumable deals, talk about why it could be beneficial for their seller, talk about these companies that will help push it through and get it done in a reasonable timeline. That's an important part of the process, is getting the listing agent on board and educated so that she can educate her sellers. All right, a couple examples. Garrett's under contract on a 2.75% interest rate house right now as an assumable. 225. Heck yeah. But that's going to be a sweet deal for him. Got another client, only took $15K down to get them under contract on a 4.5% interest rate. And then I've got another buyer who's putting about $60K down to get a 3.25% interest rate home. And they're stoked about it. This is access to the list if you want it. Scan that QR code. I'll leave this up while people are mingling at the end here. And that's all I've got. Anybody got any questions? Vicki?
So when the lender tackles the DTI, are they going to include, say I'm going to buy this house as rental property investment. So is the lender going to calculate the estimated rental as the income?
Yeah.
Already?
Yeah. So for a VA loan assumption, they can use the projected rent for that house as qualifying income.
Can you talk more about the second loan you mentioned? So for example, the house has a very large amount of equity. So is that the equity portion? You
Yeah.
have to pay off them, or you do have a list of the lender can use the second loan?
Yeah. So let me just use $1 million for easy numbers. So if the home's worth $1 million, you've got to put up to 15% down on that property. So you're putting 150 down, and if the equity gap was 300, then this second lender will loan the other 150 at like 9 to 12%, assumable for 30 years. So you got to blend the rate. You got to do a little blended mortgage rate. So let's say you're assuming, what is that, $700K at 2% interest, and then you're putting 150K cash down, and then you're getting a 150K loan at 10% interest, then your blended rate is probably in the 3 or 4s, just
So
rough math.
identify the down payment is the seller or the lender?
Who?
Second loan.
Yeah, the second loan is up to 85% value of the home. That's just,
Then minus the first loan.
no, 85% of the $1 million. So they'll loan, you got to put 150K down. So take whatever the purchase price is, multiply it by 0.85, you got to bring that down. It's a little complicated. If you want to get into it, we can talk about it after. Any other questions?
So like you and I were talking earlier, this is kind of like a sweet time right now for Assumables, right? Because some number of years down the road, interest rates might be like 5%, so now you're not getting a huge benefit. And then also, as time goes on, that equity gap gets bigger and it's harder to make your numbers pencil. How long do you see this window of like Assumables being like a golden product?
Yeah. I think 1 to 3 years is the window here for this market cycle. Because you're right, if rates drop, it's probably going to put upward pressure on homes, and then that equity gap gets bigger. So if you've got to bring more cash and the difference between that rate and what you could get as a loan is not as big, the numbers just aren't as appealing or attractive. So yeah, there's kind of a sweet spot right now to do assumables. Good question.
Do you think that banks will get moving right into assumables, or there's like demand for that kind of thing with the housing prices, like politics? I mean, this is just speculating, but pressure gets put on banks to kind of cooperate more.
Yeah, I don't know about the FHA side, but on the VA side, if they drag their feet or take a while, the Veterans Administration will slap them on the wrist, and if they get slapped twice, they're like not allowed to do veteran loans. So there's a real incentive for them to start getting a lot better at this. And I think as they get more complaints about how long they're taking, how much friction they're adding, it will get easier to do.
In your experience, why would it eventually give up their right to use that in the future?
A ton of reasons, but maybe they just want to get rid of the house. Maybe they've got cash and they can go do a conventional loan or an FHA. You can do down payment assistance loans, right? Like, and get most of that 5% covered. So even if they don't have cash, to get a premium for their house, they aren't going to buy a house for a while or don't see themselves buying one. There's a lot of reasons that someone might be willing to do it. And the reality is like the VA loan is certainly one of the best loan products. I would argue that like a conventional loan with down payment assistance covering that 5% down payment at a 0% interest is just as strong as a VA loan. So anyways, yeah, the VA loan, one of the strongest, but it's not the only thing out there. But I think a lot of people like, you know, and rightly so, they earn this benefit and they want to hold on to it. And so there's a lot of that too. Any other questions? All right, cool. Well, got beer, we got water. Stick around and mingle. Thanks for coming, guys.